market's at risk, but perspective remains the most important thing. Here's what you need to know before the bell. This morning, news headlines are ringing out. Credit Suisse gets a bailout of $50 billion from the Swii National Bank. This is the first real bailout of a bank because Silicon Valley Bank really wasn't a bailout. Of course, they just guaranteed depositors, but that weighed on the markets yesterday. Markets did rally off that support, of course, going back to the December lows on the news that Credit Suisse was going to get that bailout. Of course, this morning, futures are still struggling here a little bit as uncertainty is still out there about the banking system that's important. But again, right now, there's a lot of headline risk out for investors. And again, this is where that emotional bias will step in and begin to start making you make bad decisions about managing the risk in your portfolio. Yes, you should be managing the risk. Yesterday, we reduced risk in our portfolio some more because of the uncertainty of the markets right now. We really don't have any idea what's happening within the financial system or with what the Fed's going to do next week. So again, we're going to step aside a little bit, take a little bit of extra cash right now for safety. We still have some equity exposure, not completely into zero, but again, just reducing that overall risk. Now, perspective is very important. And again, this is where investors make a lot of mistakes because they assume that, oh my gosh, markets are crashing, I'm just losing all this money. The important thing here is to focus on where you've been and where you are now as well. Look, the market is definitely down this year so far. I mean, we had a very big run at the beginning of the year. We've given all of that back up. In fact, if we go back and look here over the last 6 months, we're now starting to really kind of trade back at these December lows. So again, market really hasn't gone anywhere since December. But even further back than that, if we look back over the course of the last year, markets have really not done anything since May. In fact, where the markets closed yesterday is exactly where the markets bottomed back in May. So again, we haven't really done anything. In fact, market volatility has calmed down a bit since that August and September, October sell-off. And again, we've kind of been flatline here over the last several months. So despite the fact that it seems like there's a lot of things going wrong with the markets, markets really haven't done anything bad. But this is where we start making these emotional decisions, start panic selling assets, jumping out of stuff that we should hold on to because of this, what seems to be short-term volatility, but in the grand scheme of things, markets haven't done a whole lot. But here's the other side of this coin. When the Federal Reserve looks at the market, specifically, they look at what they call the wealth effect. Are investors better off than they were previously? And is that wealth effect still within the markets that's leading to better economic growth? Now look, first quarter economic growth right now expected to be 3.2%. The Fed is going to be looking very closely at that growth, saying economic growth is still strong. Retail sales, core sales yesterday, strong. Again, Fed's going to hike next week by probably 25 basis points because all of that data. Now, when they take a look at the markets, though, they're looking at a longer-term time frame. And if you look back over a 3-year period, yes, markets have corrected from their recent peak, but still remain well above where we were just 3 years ago. So when the Fed looks at a longer-term picture of the markets, there really hasn't been a lot of damage despite all of their rate hikes up to the current date. Again, this is why looking at your portfolio on a longer term basis rather than just a year-to-date basis will help reduce the emotion in your portfolio to help you make better decisions. Look, I have no idea what the Fed's going to do next week. I certainly suggest being a little bit more risk averse right now. But again, making decisions to be all out of the markets or making decisions based on this idea that you're losing a ton of money really isn't the case. Take a longer term look at your portfolio. It'll calm down some of the emotional swings that you have. Obviously, lots of headline risk in the markets right now, but that longer term perspective will give you a better look at where you are financially to help you make better decisions. I'm your host, Lance Roberts, and that's what you need to know before the bell.